Welcome to The Explainer. Today, we are doing a real deep dive into a super critical issue for U.S. expats. We're talking about the rule that prevents you from stacking benefits from the Foreign Earned Income Exclusion and the Foreign Tax Credit. You know the one? It's all laid out in Internal Revenue Code Section 911D6, and we are going to deconstruct it piece by piece.
All right, so here's what we're going to cover. First, we'll tackle the big picture, the whole double taxation problem. Then we'll look at the two main relief options, the FEIE and FTC. After that, we dive into the no double benefit rule itself. We'll see how to calculate the disallowance, then look at how this other stacking rule makes things even more complicated. And finally, we'll wrap it all up with what this means for actual tax strategy.
All right, Section 1, the double taxation problem, a U.S. anomaly. So before we get into the weeds of the rules, we got to understand the foundation of this entire issue. It's kind of what makes the U.S. tax system so unique.
So here's the deal. Most countries on the planet have what's called a territorial tax system. Basically, if you earn money there, you pay tax there. Simple. But not the U.S. Nope. The U.S. has what's called extraterritorial taxation. It means that as a U.S. citizen, it doesn't matter where in the world you earn your money. Uncle Sam wants his cut. And this, right here, creates the immediate risk of double taxation. You're getting taxed by your host country and by the United States on the very same income. Ouch.
Okay, on to our next section, relief, FEIE, and FTC. These are the two pillars of relief. So, to deal with this double taxation problem, Congress came up with two main ways to give expats a break. Think of them as the two primary tools in the toolbox.
Now this is where it gets really interesting, because these two tools work in completely different ways. On one hand, you've got Form 2555 and the Foreign Earned Income Exclusion, or FEIE. This one's like a gatekeeper. It just takes a big chunk of your foreign income and says, nope, we're not even going to look at this for U.S. tax purposes. It literally shrinks the pot of money that can be taxed. Then, on the other hand, you have Form 1116 and the Foreign Tax Credit, the FTC. This is totally different. It doesn't touch your income calculation. Instead, it waits until the very end, looks at your final U.S. tax bill, and then gives you a dollar-for-dollar credit for the taxes you already paid to another country. So one shrinks the income, the other shrinks the tax. Two very different philosophies.
All right, this brings us to the heart of the matter. Section 3, the no double benefit rule. This is the statutory guardrail that Congress built to stop people from, well, double dipping. You can't use both of these awesome tools on the same exact dollar of income.
And look, the law is crystal clear on this. It's not a gray area. The statutory text of Internal Revenue Code Section 911D6 pretty much spells it out. It says, no deduction or exclusion or credit shall be allowed to the extent such credit is properly allocable to or chargeable against amounts excluded. What does that mean in plain English? It means if a tax credit is tied to income that you've already excluded, you can't claim that credit. The law is unambiguous, no double benefits.
So here's the bottom line, the simple translation. The law basically forces you to pick a lane. For every dollar of foreign income, you have a choice. You can either use Form 2555 to exclude it from your U.S. income, or you can use Form 1116 to claim a credit for the foreign tax you paid on it. You can't do both. It's one or the other. Once you exclude that income, you forfeit any right to the tax credits that came with it.
Okay, so how does this actually work on your tax return? I mean, how do we calculate the disallowance? Well, the IRS doesn't just eyeball it or use some rule of thumb. Oh no. There is a very precise mathematical formula for this, laid out in Treasury Regulation 1.911-6C. Let's break it down. So here's the formula. It's actually a pretty straightforward pro-rata calculation. You take the amount of foreign income you excluded, that's your numerator. You divide that by your total foreign earned income for the year, that's your denominator. So you get a percentage, right? Then you just multiply that percentage by the total foreign taxes you paid, and voila. The number you get is the exact amount of your foreign tax credit that the IRS disallows. It's that simple.
So a few key things to remember about this formula. First, it's a pro-rata calculation. It's all about proportions. So if you exclude, say, 80% of your foreign income using the FEIE, guess what? You automatically lose the credit for 80% of the foreign tax you paid on that income. It's a mandatory scale down. You can't get around it. The whole point of this exercise is to surgically remove the taxes that are tied to your excluded income, so you're only left with credits for taxes paid on the income you didn't exclude.
Okay, so you think you've got it figured out, right? You exclude some income, you lose some credits, simple math. Well, hold on, because this is where a huge complication gets thrown into the mix. We're moving on to the stacking rule magnifier.
Back in 2005, a law called TIPRA introduced something that completely changes the game and makes all of this way more impactful.
So this stacking rule, which you'll find in IRC Section 911F, is an absolute game changer. Here's why. Before this rule came along, if you earned income above the exclusion amount, that extra income would get taxed starting from the very bottom tax brackets, 10%, 12%, and so on. But not anymore. Now that leftover income is stacked on top of the money you excluded. What does that mean? It means your unexcluded income gets pushed way up into much higher tax brackets right from the get-go.
So how do they do this? It's a clever three-phase calculation. First, you figure out what the U.S. tax would be on your total income. Just pretend the exclusion doesn't even exist. Step 2, you calculate the tax on only the excluded amount. And then for the final step, you subtract the tax from Step 2 from the tax in Step 1. The number you're left with is your final U.S. tax. It's kind of a roundabout way of doing it, but what it's really doing is taking away the benefit of those lower tax brackets, making sure your taxable income is taxed at those higher marginal rates. And when you see it visually, the impact is just, wow, it's staggering. Look at this example. Say you have $50,000 of salary that's not excluded. In the old world, that $50K would be taxed starting at the nice low 10% rate. But now, with the stacking rule, that same $50K is treated as if it's sitting on top of the, say, $120,000 you excluded. So instead of starting at 10%, that income is getting taxed at a rate that starts way up at 32%. It's a massive difference.
Okay, so this brings us to the strategic implications, and this is where things get really tricky. What happens when these two rules, the credit scale down and the income stacking, collide? Well, tax pros call this mathematical friction, and it creates some seriously tough dilemmas for expats.
And that friction isn't just a concept, it's a number. Look at this, 11.6%. Here's how you get there. In a very possible scenario, the stacking rule could push the marginal tax rate on your unexcluded income all the way up to, say, 39.6%. But your effective tax rate in your host country might only be 28%. You see that 11.6% gap? That's the problem. That's a void where your scaled-down foreign tax credits are just not big enough to cover the massively spiked U.S. tax bill on that last bit of income.
So this creates a real dilemma for practitioners and their clients. First off, you're left with insufficient credits. Your scaled-down FTIE just can't keep up with the high U.S. tax rate that stacking creates, meaning you actually owe money to the IRS. Second, this is a nightmare for withholding. U.S. payroll systems are often not set up to handle this, which can lead to a huge tax bill and under-withholding penalties when you file. And third, there's the revocation trap. You might think, okay, I'll just revoke the FIE to avoid this mess. But if you do that, the rules lock you out. You can't use the exclusion again for 5 years unless you get special permission from the IRS. You're kind of stuck.
So all of this leaves us with a really critical question, especially for any of you working abroad in a high-tax country. Does this crazy, complex interplay of rules, the credit disallowance from 911D6 smashing into the stacking rule, does it actually turn the foreign earned income exclusion from a relief provision into, well, a financial trap? Does it end up punishing the very taxpayers it was meant to help? That's really the central challenge here, and it's something every U.S. expat has to consider.